Welcome back to the Macro Real Invest channel. My name is Zoltan. I'm the host. Today, I have the pleasure to welcome Jonathan Haas from Altius Capital. Jonathan has been underwriting in his past billions of complex real estate credit and equity transactions, but transition in a more liquid space. Welcome, Jonathan. It's great to have you here.
Thank you. Thank you for having me. It's a pleasure. We've got a lot of time zone difference between us, but I see that the sun is shining outside where you are, and the sun is shining outside here in the Midwest. And so to be here.
I'm in the sunny Switzerland near Zurich, and you are in the States.
I'm in Kansas City, so we're about a little bit less than an hour's flight away from Chicago, which is obviously the American heartland, but also the heartland of the American futures and options industry. And, short spoiler alert, but the hedge fund that I run is in the future space, futures and options space. And so there's a little bit of a connection there, but we can get to that.
Can you tell a bit about your background, which has been you have been at the big institutional players, and why did you choose then to transition to the liquid space, but one after the other?
Yes, absolutely. So as the name may suggest, I was actually born and raised in a small town in Germany called Hildesheim in the northwest of Germany. I also have a sister who actually now lives in Switzerland. So there's some great connection, and it's a real pleasure to have that. So I frankly never expected myself in Kansas City in the American Midwest. As the story actually goes, I met a girl, I fell in love, and the rest is history there. But prior to that, I studied in the UK at the University of Oxford. I'm actually part German, part British, and received my MA in economics and management. I started my career at Morgan Stanley in investment banking in London, and then I moved to Blackstone in London, supporting their real estate credit group in London, and then later on in New York. And so I did that. After leaving Blackstone, I ended up returning to Europe. I ran and helped run the European commercial real estate credit origination business for the Royal Bank of Canada in London, and then latterly in Toronto until I left in 2025 for this new venture in Kansas City. I spent the last year researching, planning, thinking a little bit how to set this all up, sort out all of the various different nuts and bolts around that, setting up the companies and these types of things, and really planning how I can bring as you mentioned, 14 years of private equity credit investing experience to investors in a little bit more liquid, uncorrelated alternative investment strategy that still provides strong absolute returns for investors. And that's really how I ended up setting up Altius Capital, and how I ended up that Kansas City is the place to be for this as well. Being so close to the heart of the options, futures, commodities investing world, which is based in Chicago.
And what made you leave the private, like real estate or private credit industry?
I think there's a couple different things in that statement. I think the one was in the private credit, private real estate world, of course, you have different challenges, especially post 2022. You saw a couple of different things, which I'm sure we'll touch on as well, but you saw transaction activity dry up a little bit. You saw some of the, distress that we've seen over the past, 4, maybe 5 years play through refinancings and those types of things. And I, as a previous private equity investor, have seen just what happens when the distributions in the private equity world dry up, right? And so there's a lot of endowments, pension funds, individuals that rely on the current income that these alternative investments provide to people. And when those dry up, that sort of cogs up the system. It gums up the system. You see some of that reflected in the lack of fundraising on the private equity side of things right now. You see some of that on the lack of IPOs, exits. You see the average duration of a private equity, private credit deal get longer and longer. It appears to get longer by about a year every single year. And I wanted to find a way to provide mark-to-market, liquid, but uncorrelated investment returns to investors, and to do that in a strictly risk-managed way. So one of the things that I really care about is making sure that we limit our drawdowns and that we're very controlled in that regard. But we'll get to that in a second.
Yeah. So, but let's stay still at the private credit side before we talk about the liquid space. So, with your experience, if I have you here, what is your take on the fallout of private credit? So, we have seen quite some problems there.
Yes.
Do you have any view on that? Is that more a 2009 type of experience, or how do you see that?
I think it's really quite interesting because you're seeing a lot of these headlines come out, especially in the US. You've seen some of the, headlines around Blue Owl. You've seen some of these around, Blackstone in their private equity fund. And I think there's a little bit of a two-sided world, right? The issues that you've been seeing is in those private credit vehicles that are in some way promising liquidity that doesn't really exist in the private credit world. And the way that I think about it is if I provide a loan or I provide some sort of private credit, my expectation is that I should hold this to maturity. But once again, and you're not immune to this. You've seen this in the REIT equity space as well. You're promising someone liquidity when the underlying assets aren't liquid. And that has happened. It happened in 2009. It happened in the beginning of the 2000s. It happened in 2012 to 2014 in Europe to some extent. So you've seen this whole story before. And I think that private credit is no different in that regard. Now, one of the differences that you've seen on the private credit side, especially on the real estate side, is that the heyday of the private credit world started as a result of the low interest rate world that came about as a result of 2020, 2021. Yeah. And then a lot of those investors realized that they opened up the world to high net worth, effectively retail investors, right at the peak of that craze. I say craze, but right at the peak of the proliferation of private credit. And then you had a meaningful interest rate tightening cycle across the whole world, in the US, in Europe, UK, Switzerland, perhaps a little bit less so. And that was in 2022. And people realized that actually, especially real estate, especially these income generating products, are a direct reflection of how base rates are moving. And that meant that as the liquid world moves, right, treasuries sell off as the yields go up, you're suddenly in a world where what was once par is not par anymore, because the alternative is that you can invest in, a bond, you can invest in gilts, you can invest in US treasuries at a similar return as you used to do, either buying real estate outright in many parts of Europe where cap rates were very low, or providing a loan at, some sort of minimal spread to base rates. And so you're seeing the fallout from there. And I think that is taking time to play through in really the majority of the Western world.
Absolutely. So you always ask about the future and try to protect then the downside. So let's see how this evolves. But let me move into your field of where you are now active. Can you elaborate a bit more on the liquid future space where you are now?
Yes, of course. So in the sentence, Altius Capital is a futures fund and running a global macro volatility strategy. We'll get to the second part of that sentence in a second. But the futures world really gives me access to different themes of the investment world. We don't invest in single name stocks. We don't invest in, individual equities. We invest in equity indices. So the S&P 500 perhaps, or, the NASDAQ or other, large, broad benchmark indices. We invest in currencies. We invest in the broad commodity space. So precious metal, energy, which means oil. Then we also take advantage of agricultural commodities, wheat, corn, soybeans, and obviously interest rate products. And so what that allows us to do is gives us a very broad palette of, I don't have to invest in a sector or a theme that I'm not interested in. And the real estate analogy for that is, if I look at the real estate world as a whole, if I can choose between an industrial REIT or a retail REIT or multifamily, these are all different expressions of the same theme, in the same way that I can take advantage of the future space, whether I think there's an opportunity in currencies or equities or oil or grains or various different futures products. And
yeah. It's a space more like a hedge fund type of strategy. Would you call it like a global macro, or how would you characterize yourself?
I think that's a great question. And the answer is probably secret option C or maybe E. It's run as a hedge fund strategy. Altius Capital is a hedge fund. It has specifically a hedge fund commodities trading license, and that's how we operate. Now, if I look at the different hedge fund types, there's equity hedged, so equity long short, and there's event driven, so, merger arbitrage, those types of things. There's, the quant world, so, convert arb, the various high frequency or market making hedge funds. And then there's global macro. What I do in short is a directional macro strategy. We take directional views across that futures landscape, and we overlay a very strict risk management rules-based strategy. So we make sure that from our high watermark, if we're down 7.5% from that, we cut our risk in half. And then if we're down 12.5%, we cut our risk in half again. And we only get that back if we earn our way back to, being back to high watermark or being back to those different risk levels. And that allows me to not be in a situation, as we've seen actually last week over the weekend, where, some of these hedge funds, they are liquid products. They have these really fast moving, equity positions. That's not really what we're trying to achieve. What we're trying to achieve is a very risk managed absolute return strategy that creates returns whatever the environment that we're in. Having a directional view and overlaying a short volatility strategy. And what that means is that after a big, forest fire, so to speak, we go out and we will sell fire insurance. That's in a nutshell how we think about that. And that really gives us two ways to win. We either have something where we invest in a price extreme. The price has either run up very rapidly or the price has gone down very rapidly, and we believe that there is some sort of mean reversion in the price, or we see a mean reversion in volatility. And the way that manifests is in the same way that following, a forest fire, you're seeing insurance premiums rise very rapidly. As a result of that, we see the same thing in equity markets. So when volatility is very high, people demand that insurance. We can be a liquidity provider of that insurance, and we can take advantage of those dislocations in the market while expressing a directional view.
I think that was a very good expression and differentiate you from the guys who were just now in on the AI train with a lot of leverage and have getting margin calls. So on your side, is certainly the focus is much more on also risk management and downside protection. Absolutely. And how much is your credit background of use in managing risk? Because on credit underwriting has been also always managing downside risks, of course.
That's exactly right. That's exactly right. And that's exactly why I ended up coming to this strategy. As a credit investor and as a real estate investor as a whole, the one thing that we spend so much time on is what happens to the downside. We always underwrite, how do I lose money? How do I lose money? How do I lose money? If I take advantage of the strategy that I do, we go to where price extremes are, we go to where volatility extremes are. The thing that I am constantly thinking about and that I spend so much time on is, how can I lose money in this trade? And I don't want to be in a position where all of a sudden I invest in something and the price moves against me and we wake up and, suddenly the transaction has lost meaningful amounts of money. That's why we have this downside protection mechanism. The other side of it is that selling a put option, for example, which gives you or gives the put option buyer the right to sell something to me if the price has gone down, it's a little bit like writing a loan. So if I sell a put option, say on the S&P 500, and right now the S&P 500 is at, somewhere between 7,400, 7,500, I can sell a put option betting on the price of the S&P 500 not falling below 7,000 over the next 30 days. If the S&P 500 drops below that, I have to come out of pocket. Now, similar to writing a loan, I will get paid a premium in order to provide that protection to someone, which is similar to an interest rate. And I am also investing in that asset through the loan mechanism, or in my case, through that put option mechanism at a discount to the underlying asset. So I don't necessarily have to see the underlying asset appreciate in value in order to make money. And that gives me a little bit of a margin of safety to be right. So in this case, for example, the S&P 500 can drop by 10%, and the put option that I provided to someone, I collected my premium over the last 30 days, and the put option still expires worthless, and I still collect all of that premium, and the insurance has effectively been provided, but it's expired worthless. And that's similar to writing that loan, because if I write a 75% LTV loan on a multifamily asset, that multifamily asset can drop in price by 25%, and I, as the person who provided the loan, still hasn't lost money. And that is the same analogy of how I think about this credit underwriting mindset and the strategy that I have.
Right. But generally, if you're more into global macro space, are you more using a fundamental approach, or is it a technical analysis, or a combination of both? Or
it's a combination. So in order to have a directional view, I need to have some amount of fundamental analysis. And that can really be the form of, I believe that, let's take that same analogy on the S&P 500. The S&P 500 has fallen too far, too fast. And I believe that price does not accurately reflect the short or medium term price of where it should be. So that's a directional view. And I need to have some sort of analysis behind that makes me believe that I am right in that. Another way to look at it in the commodity space, for example, is we've seen the price of oil fall. We believe that there is going to be a continued shortage through, global events that we've seen over the last couple of months. And as a result, I believe that the fall in the price of oil does not accurately reflect the actual underlying reality of what should happen to the price of oil. And so I can take that directional view. And the other side of it is the volatility mean reversion that I spoke about. And the way I really think about that is a little bit more technical, because volatility really just means the oscillation of prices and how much those prices move, which is a little bit like a rubber band. And as I stretch that rubber band more and more, that rubber band wants to come back together, and it wants to snap back together. And if you have the price of volatility be really high, that implies that in the future we believe that prices will continue to move very, very rapidly. Now, the reality is that once you've seen a large risk event, generally that volatility mean reverts because people's expectations are pricing that in now. So generally you see a large dislocation, volatility spikes, prices fall rapidly, or maybe prices rise rapidly, and then things sort of slowly move from there. And that's really what we mean by the volatility mean reversion. So,
and just one question to jump in: do you play it both ways? Also, when the volatility is low, on the rise of the volatility, and the other way, just after shock events, that there is this kind of more mean reversion. Sometimes in the futures, you cannot play it the right way, but do you do both? You apply both?
Yes, absolutely. Absolutely. So volatility effectively is something that can be sold, but also purchased. And the way that we see the world is really that when volatility is at its lowest, we want to use the least amount of our capital. We want to keep a lot of dry powder. And the reason for that is twofold. The way that I would probably explain that most easily is we want to put ourselves in a position where we can get lucky, effectively. So luck is where preparation meets opportunity. If you are in a situation, let's use the S&P 500 analogy again, we're in an environment where right now the fear is not really priced into the market. So the risk of an outlier move, unpredicted outlier move, a black swan event, as we would call it in finance through the terminology, coined by Nassim Taleb. We want to minimize our risk of an outlier event hurting us when prices are low. But as prices come down, as volatility goes up, as we mentioned, the expectation of price moves gets higher and higher, which means that the risk of an outlier event is lower, because if the market is pricing in 10% moves every day in a product that usually moves 1%, an outlier move doesn't really scare you anymore, because it's the volatility prices out into the market, and I can take advantage of that. But if I'm at a situation where, the S&P 500 is at all-time highs, the expectation in the market is tiny moves, then one unexpected black swan event can really wreak havoc. And that's really why we think about using the least amount of capital when volatility is lowest. And then, of course, when you're in a situation where that volatility is high, the insurance premium or the fear premium that you're selling is high. And from a directional perspective, I would rather be investing in the S&P 500 when it's dropped 30% than when it's run up by 50% over the last 2 months.
Yeah, I'm also a kid of the crisis, managed the Swiss Bad Bank during the
That's
GFC.
right.
So I'm always thinking about, I'm always wary what has happened, for example, with the semiconductors just going up and up.
Exactly.
I don't like this type of moves. I rather stay on the sidelines in such environment, but certainly sometimes you get punished for it. Not to dance as long the music is playing. So, but I think in if one has more a longer term view, then it is paying out. But one interesting question is, you have been actually a lot of our viewers are more allocated in a slow moving asset class like real estate credit and real estate debt or private credit. What would you say to them? Why should they look at such these more liquid futures strategies as well? So
yeah, and I think that's something where obviously each individual has their own reasons for why they invest the way that they invest. What I would say is, if you have a large amount of your capital tied up in real estate, those assets aren't liquid, and as a result, when the trends shift, you are in a situation where you probably can't adjust as fast as you would like to in that real estate portfolio. If you had a side of your portfolio invested that is uncorrelated to those markets, it is actively marked to market, and it is downside protected, meaning that the capital that you sit on it's not going to be capital that you have to take an immediate loss on. It's something that can be reinvested either at a time of great fear where there is a lot of abundant opportunities, and you can take advantage of where the new opportunities lie. You've seen a lot of private equity funds in, Europe, the United States that have been invested in, the pre-COVID world that were invested in offices. Many of those still sit on those portfolios. If I, through Altius Capital, had the opportunity to take a position in those portfolios, I can sell those assets at the click of a button. I can be out of those positions and I can start rebuilding immediately. I don't have to carry historical legacy positions in my portfolio. And so that liquidity allows me to really move to where the new opportunities are and to build positions in those new opportunities. And I can do that right away. I don't have to be in a situation where I sit on assets that I can't sell. I sit on assets that I maybe don't like anymore as a result of that. I can move those and I can switch those very rapidly. And that, especially as either an institution that has ongoing commitments like a pension fund or an endowment, or as an individual that has perhaps children that go to school as I do, or individuals that maybe want to retire and live off this income. If you are in a situation where those assets don't provide income to you anymore, those assets don't help you. I provide an alternative that generates returns, that marks those assets in a way that is agnostic to the environment that we are in. And that's where the benefit to individuals is. It provides a sleeve of capital that aims to provide you returns regardless of the environment. And that obviously all sounds wonderful when people talk about hedge funds in all of these different ways. The way I like to think about it is we started our fund in March. We didn't lose money through the Iran war. And we have, over the last 5 months since the beginning of the Iran war generated over 12% net returns to our investors. Our largest drawdown was in the realm of 3.5%. And we have never had a month where we have lost more than 0.5% for our investors. And that is the mission that we have. I am my own largest investor. I provide capital to it myself, and I'm the largest fee payer to the fund as well. And so I practice what I preach. My interests are aligned with investors, and we try to provide this to our investors in a way that makes sense, not just for them, but it makes sense to wider institutions and people who look for these uncorrelated returns.
And certainly you have quite a lot of skin in the game. To talk again, take one quote from Nasser Taleb. So what is for you a good return, and what is for you a good management as somebody who has skin in the game, also compared to other players who are managing money for other people without this skin in the game?
Yeah, absolutely. I think, of course, if you run a hedge fund, taking a step back, you ultimately get paid on performance, right? You obviously have a small amount of management fee. In this case, for us, it's 1%. We actually use those to just cover our structuring fees, our structure, the fund, the audit, all of these accounting costs, those types of things. And so really it's the performance fees. And so every hedge fund in that way has their incentives aligned. They don't get paid if the hedge fund doesn't make money. They only get paid if the performance of the hedge fund is good. We also have a hurdle where if I don't generate at least 6% annually for my investors, there are no fees whatsoever. We don't pay fees if the fund doesn't at least reach a 6% hurdle. The other side of it is that with all of my liquid net worth invested in the fund, there is no concept of other people's money anymore. This is my money. And so that makes me think twice about every investment that we have. I think that I would think about it twice regardless. But the most important thing is that I don't want to be in a situation where next month or in 2 months or overnight, I wake up and 20% of the fund is gone. I don't want to wake up in that situation. And that's why we have these portfolio level drawdown protections. And we don't want to be in a situation where a crazy black swan event wipes us out. We want to be in a situation where one of those black swan events gives us an opportunity to outperform. And that means that I want to be in that position as well. And I want to make sure that I protect my capital, our capital, the fund's capital in the most controlled way possible. I think that mathematically, if you look at it, most hedge funds have less of an issue outperforming necessarily. They have an issue with protecting their downside. And being in a situation, mathematically speaking, where you have large swings down, it makes it much harder to grow from there. If you lose 50% of your fund's assets, you need 100% return in order to get back to where you were before.
Yeah, absolutely. And that's what the mathematics some people don't realize.
Exactly. And so protecting that downside is paramount for long-term outperformance.
Just like also finally, it has been very interesting. So can you give us also an example of a recent market dislocation where you could use the short option premium strategy? Certainly here we're not providing any investment recommendation to our listeners, but I think it's sometimes because we are in such a complex space, examples can help.
Yes. So one of the positions that we've recently had was in gold. You saw since the beginning of the Iran war in March, gold has massively sold off. And so that was in response to people having to, in the Middle East especially, these regimes having to raise capital. They didn't have the oil revenue in order to do so. And as a result of that, they needed to have other hard assets in order to, keep paying their obligations. And we saw that as an opportunity for one of the legs of our strategy, the price extreme strategy, to be deployed. And not only did we deploy it as a directional move, but we also took advantage of the volatility in that gold move that was elevated as a result of the recent price moves. And so the way that we expressed that opinion is that we sold the that we sold a gold put option. So effectively, we needed the price of gold to stay above a certain price over the next 30 to 40 days. So we would make money if either the price of gold goes back up and the price of the protection falls as a result of that, because the price of gold is further away from where the insurance is that we wrote, or if the risk in that insurance, because the volatility of gold keeps falling and time passes. And so obviously we receive effectively a daily insurance premium price to provide that put option to the people who would like that protection. Now, as we saw, if you look at a gold chart, the price of gold hasn't gone back up. The price of gold has actually stayed relatively steady, but it's certainly not.
Yeah, it's around this 4,000 now.
That's right.
Yeah.
And so really, that was a great expression of the strategy that we have. It gives us, every trade that we have gives us two ways to win. Either the price moves in our direction or the volatility helps us and moves us in our direction. And so in this case, we saw that as time passes, the value of that insurance gets less and less until it expires, worthless. And that's really what happened here, because the price of gold didn't move in our direction. It didn't turn out to be correct that we thought that the price of gold would go back up. But because the insurance premium that we wrote was 10% below the price of gold, just the fact that the price of gold didn't continue to drop by another 10% allowed us to be profitable on that position. And that really is the essence of what we try to do at Altius Capital. We try to find ways where we can capitalize on a dislocation, and we can capitalize on that by not necessarily being correct, but just not being wrong is what we need. And so
certainly on the downside. So it's always a question when you do such, if you're writing options, it's always not doing it too early and not too late, because if you're doing it too late, then you're not compensated for it. So it's
That's right.
That's the trade-off usually.
Yes. We absolutely want to be in a position where we find the right entry point. And the right entry point can be assessed in various different ways. We can look at fundamental analysis. We can look at technical analysis. We can look at weather patterns for grains, and we can make an assessment that the price has either run up too far too fast or the price has fallen too far too fast. And so then once we have that view, we can assess whether we want to be in that product or whether we believe that it is not necessarily the right place to make a bet. And because we are across various different products, be it oil, be it equity indices, be it currencies, we have 4 or 5 different ways to express a directional view. And so, if we are in a situation where we don't like the situation, we aren't forced to transact. And if we like the direction of the market that we're in, we can transact. And that really means that we can be selective. We are not like an ETF that has a mechanical strategy where they have to make a trade even if they don't want to. So we have the discretion to see that a market maybe has an opportunity, but it's not a market that we find interesting right now. Maybe, the volatility around the product is a little bit too high for us, right? There's probably a sweet spot in how volatile that product should be and can be. And the result of that really means that we can play in whatever field we want to be in, but we have to make sure that that field aligns with our fundamental view and it aligns with the mechanical downside protection view that we have in the product that we have.
Awesome. I think that you have explained it very well. Also pretty clear and easy, and hope some of our viewers certainly like it. And if they have any question, also please put that to the comment box. So we'll also get back with questions if you have any. Jonathan, so if people want to find you, where can they find you, and how can they get in touch with you if they have further questions?
Yes, absolutely. So online we have a website, Altius, Altus Cap RE, altiuscapre.com. You can send me an email at jh@altiuscapre. We actually have a form on the website where you can reach out to us directly as well. Of course, you can find me on LinkedIn as well. And you can also just Google Altius Capital and you will find us there as well. Of course, any comments in the video as well, we'll be happy to reach out to you if that's something that's interesting to you. But find us over email, over the internet, or just directly reach out to me on LinkedIn. We'd be happy to have a conversation, or if you have any comments or questions just in general, we're always looking forward to chatting to people. We're always excited to have a conversation. And if you're interested in real estate and you're interested in how all of these things fit together, please reach out. I love having these types of conversations.
Thank you very much, Jonathan, that you were with us.
Thank you.
Wish you also good luck also, and we'll bring you back also in the future, of course.
Thank you so much. It's been a real pleasure. Thank you. Bye-bye.
Bye.